Hi candidates, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Financial Reporting and Analysis. So in this session, I want us to look on the last topic in Financial Reporting and Analysis, and the topic is the analysis of financial statements. So as far as this topic is concerned, we are going to discuss a number of issues. One, we are going to look on what is analysis of financial statements, what are maybe some of the importances of the same, the limitations of financial statement analysis, and then later on we are going to look on various tools which can be applied, which can be used by a financial analyst in terms of analyzing the financial statement, majorly the income statement and the statement of financial position. But to start with, I want us to define what is the analysis of financial statement. And as the name suggests, this is the process of analyzing the financial statement prepared by the company for the financial analyst to extract extra information or basically additional information, which then will be used in terms of making what decision. For example, if the management of the company want to make some decision, they may need a financial statement now to be analyzed further, so that now the information which will be given or provided to them then can be used in terms of what analyzing the financial statement. So therefore, analysis of financial statement, we have said that this is a process, the process of analyzing financial statements of a company for the purpose of decision making, making, of which in this case the person who analyzes the financial statement prepared by the company, that person is known as financial analyst. So what the financial analyst will do, for him to be able to analyze the financial statement of the company, he must be provided with copies of financial statement prepared maybe for the last 2 or 3 years, combined with other information of the company like the auditor's report, the director's report, and then we will be able to extract more information, which we are saying then will be used in terms of making what a decision. Now, in this case, what I've said is that we have various tools or basically various techniques which are used in terms of analyzing the financial statement. But before we look on or we discuss in details those particular tools or analysis or techniques used in analyzing the financial statement, maybe first of all we can look on the qualities of a good financial statement analysis, qualities of a good financial statement analysis. Financial statement analysis, this is abbreviated as FSA. We have basically a number of qualities here. Number one, we can talk of reliability. So basically what this means is that the information which will be provided by a financial analyst, or basically the person who is charged with the responsibility of analyzing financial statement, that particular information must be relied upon by the users, or the users should be able to rely on that particular information for them to be in a position to make a number of what decisions, of which in this case we say that that information is actually reliable. One, if that information which is provided by the financial analyst is free from any error, and number two, that particular information is complete. All what now the users need to be provided to them is provided by the financial analyst, and also on the other hand we say that that particular information is what neutral. So therefore in this case information which is provided by financial analyst is said to be reliable. One, if that information is free from any error. Number two, that particular information is complete. is complete, and also on the other hand, that particular information is what? Neutral. So if that is the case, then we say that the information provided by financial analyst is what? Is reliable. Number two, or the other quality of a good financial statement analysis is what we refer to as relevance. Relevance, or basically we can talk of relevancy. So when talk about the information being relevant, it means that once a financial analyst has analyzed the financial statements of the company, then that information must be relevant. Relevant means that the users should be in a position to use that particular information in terms of making their intended decision. Otherwise, if the users cannot be able to use that particular information in terms of making the intended decision, then we say that that particular information is not what? Is not relevant. So therefore, information here will be said to be relevant if that particular information can influence information provided by financial analysts, by a financial analyst must influence users' decision, must influence the users' decision, must influence the decision now which will be made by the users. Otherwise, if that particular information cannot influence the decision which will be made by the users, then by the end of the day, we are saying that information is not relevant, relevant. So the other quality of a good financial statement analysis is timeliness. Timeliness. What do you mean by timeliness? It means that for a good or for any information which is provided by financial analysts to help the users in terms of making decision, then that particular information must be provided on time. Otherwise, if the financial analyst has analyzed the financial statement and he does not provide that information on time to the various users, the users cannot therefore be able to do what? To use that particular information in terms of making what? Decision. So therefore, the information must be provided on what? Must be provided on time. Then we also have the other quality of a good financial statement analysis, and that is what we refer as understandability. Basically what this means is that the information which is provided by financial analyst, equally that information must be readily understandable. The various users should be in a position to understand that particular information such that they can be able now to rely on it in terms of making their what? Intended decisions. So therefore, these are some of the main, or basically these are some of the qualities of a good financial statement analysis. Now, equally what you have said is that a financial analyst, when analyzing the financial statement prepared by the company, applies or basically uses various tools or techniques. And I've said as per your syllabus, we should only cover two, something called the ratio analysis, and number two, what we refer as the common size, or also known as the vertical analysis. So therefore, we can look on the tools, stroke techniques of FSA. We have said this is financial statement analysis, and actually this is the same with the analysis of financial statements. So the tools or the techniques which are applied by a financial analyst include, we have two main of them. So we can say that these tools include number one, ratio analysis, and number two, we have the common size. This one is also known as the vertical analysis. Though we also have another one, number three, which is called the horizontal, also known as the trade analysis, But as per your syllabus, as per the syllabus of FRA, we need only to cover the first two. So we're not going to cover the third one. These are something which is covered in financial management intermediate level. So let's start with the common size. We start with the common size, which is also known as the vertical analysis. Vertical analysis. So what do you mean by the common size or the vertical analysis? So this is a tool or a technique of analyzing the financial statement, majorly the income statement and the statement of financial position, and it entails expressing all the items in the financial statement as a percentage of a certain base item. So mean that the items in the income statement, the items in the statement of financial position will be expressed as a percentage of a certain base item. So therefore you can say that this entails expressing all items in financial statement as a percentage of a certain base item, as a percentage of a certain base item. So therefore we are saying all the items which are included in the income statement, in the financial statement, will be expressed as a percentage of a certain base what item. Now here we have the common size or the vertical analysis of the income statement, and that one entails converting or expressing all the items in the income statement as a percentage of the company's revenue or as a percentage of the company's what? Sales. The objective here is that the financial analyst want to establish the relationship between the items of the income statement and what? The company's revenue. This particular information is very, very important to the management of the company, especially when it comes to decision what? Making. So therefore, we have the common size, which is also known as the vertical analysis of income statement, and in this case we have said that this entails expressing items in the income statement as a percentage of revenue, That is very, very important. All the items in the income statement will be expressed as what? As a percentage of the company's what? Revenue. And we have said that the objective of this particular analysis here is to know the relationship between the items of the income statement and the company's what? Revenue. Basically what we have said is that that particular information mostly is will be used by the management of the company in terms of making what? Decisions. Like maybe let's assume that a financial analyst has been able to do this analysis. He has expressed all the items in the income statement as a percentage of the company's what? Revenue. And for example, we assume that we are given this particular results. So we have the revenue. So revenue, always this one, whenever it is expressed as a percentage of itself, is always 100%. Also, let's assume that we are given the cost of sales here as a percentage of revenue to be something like 60%. Maybe other expenses like administrative expenses to be something like 20%, and so on. So how is this particular information important to the management of the company? This information is important because as a manager of the company, you can see that the relationship between administrative expense and revenue is 20%. What that means is that for every for every 100 shillings of the revenue which is made by the company, 20 shillings basically is used by the company in terms of catering for administrative expenses. 60% of such amount, for every 100 shillings of the revenue, 60 shillings is used by the company to cater for what? The cost of sales. So you can see this information is important to the management of the company, particularly when it comes to making now the internal what? Decisions of the company, and maybe decisions regarding the management of the company's operating what? A cost. So therefore, that's what we mean by the common size or the vertical analysis of the income statement. Number two, we have the common size stroke vertical analysis of statement of financial position. So what do you mean by this? So this, on the other hand, entails expressing all the items in the company statement of financial position as a percentage of the company's total assets. So everything in the statement of financial position will be converted as a percentage of the total asset. So we can say that this entails expressing items in statement of financial position as a percentage of total assets, as a percentage of total asset. And equally in this case, the objective here will be to establish the relationship between items in the statement of financial position and the company's total what? Asset, and the company's total asset. So therefore, that's what we mean by that first tool of analysis, which is known as the common size. But equally in this case, we are saying it can also be known as what? The vertical analysis. So there was a question which was examined on this in the sitting of August 2022, but you're going to look on that particular question as one of our illustration what? A question. But before we do that, I want us to discuss on the other tool of analysis, and that is what we refer to as the ratio analysis. Ratio analysis.